Welcome back to the Teaching Tax Flow Podcast, episode 135 today. We are looking at how your filing status can greatly impact your tax returns. So before we get into that topic, as we always do, let's take a brief moment and thank our episode sponsor.
Are you leaving money on the table? Are you an accredited investor seeking new and exciting investment opportunities? Look no further than Integrated Investment Group, your trusted partner in financial success. At IIG, the focus is on delivering exclusive investment options tailored to your unique needs and goals. Contact them today and let their expert team guide you toward your financial aspirations. Wondering if you qualify as an accredited investor? Visit teachingtaxflow.com/IIG to find out and take the first step towards a brighter financial future. Integrated Investment Group, your path to financial success begins here. Securities offered through Cabin Securities. Member FINRA SIPC.
Hey everybody, and welcome back to the Teaching Tax Flow Podcast. As you've seen in the show notes, or you've seen in the title, you can't put a price on love. Now, what in the world does that mean when it comes to your taxes and filing status? We're about to dive into, excuse me, see, I'm getting all choked up here. Thinking of Cupid, I guess. But where I was going with that, I know there's a ton of information in this, and Chris Picciurro, welcome back to your own show, sir. But before I hand the mic over to you, as I mentioned, there's so much in this that I can imagine we could probably have a 4-hour conversation on how each status change may kind of drive you in a different direction. But in this one, we'll just kind of skim over it maybe a little bit. Now I'll give you the mic.
All right.
Welcome back,
welcome.
sir.
And John, if you really loved me, you would have bought me, no pun intended, a red Teaching Tax Flow shirt. If you are not watching this, are you listening? Go check out our YouTube channel, because I have a plethora of Teaching Tax Flow t-shirts, but nothing in red. Nothing in
We
red
could
that would
change
have been
that.
appropriate for this podcast recording. But that's all right. I still love you, and we still appreciate you. Everyone. I mean, these topics, I mean, we are very heartfelt about this. They're coming from our Teaching Tax Flow community, and that is the heart of it. Is our Defeating Taxes private Facebook group, defeatingtaxes.com. But what we've been seeing, John, actually, we are getting a ton of comments on our YouTube channel videos, which is Teaching Tax Flow's YouTube channel. And they're really good comments. So we're answering those as they come in. We love it. And because we're getting these comments, because we're listening to our community, and we have an amazing community that likes to chime in, that drives us to be able to provide show topic ideas back to the community and dive into things. And this is filing status is an often overlooked item when it comes to taxes. And a lot of times people say, well, what's so complicated about that? Well, it can be very murky, right? Marital statuses change and all the time. And it could be something that could really play with your tax situation. So today, like you said, John, can't put a price on love. I've been saying that to clients for many, many years. Even Cupid can't override the Internal Revenue Code. So let's dive into what that means. There are 5 filing statuses, and each filing status has its own set of tax brackets, right? So someone's income, that's why I want you to think about as you listen to this. We know because you're an avid listener of the Teaching Tax Flow podcast, you already know that different income is taxed at different rates. However, you could have a taxpayer with a certain amount of income, and based on their filing status, will pay a different amount of tax on that same income. That's what's so interesting about filing status. So we have 5 filing statuses, and I'm going to run through those with you today, and then we're going to talk about some quirky things and some ideas and some unique rules within those filing statuses, John. So,
And I know we're off to a great start already, because for the first time, I think ever in the history of the show, you busted out the cheesy dad joke before.
I've got a lot of them.
For me. So,
well, we're gonna
congratulations, sir.
We're going to remember that your marital status on the last day of the year, so December 31st, is your marital status for the entire year. A common question we receive is, hey, I got married in June. Do I file a tax return single for the first half of the year, married for the second half of the year? So just think about that. Whatever your status is at the last day of the year is your status for the entire year. We're going to start off with the first filing status. John, it's the status we were both at when we met many, many, many years ago.
That is true.
Single.
Singling and mingling. Well, I shouldn't say mingling. I was pretty young at that time, but I was still, I was chasing the ladies on the jet skis, I think, in the middle of the lake at that time.
Well, you were, yeah, luckily we're not single and looking to mingle, because I don't think it would bear well for us. But we are both single, and we were both single. And what does that mean?
That came across completely wrong. No, it was the
Exactly.
Anyways.
Trust us, guys. It was over 20 years ago, if you're listening to this.
Oh, God.
So what is single? I mean, you might chuckle at this and say, oh, come on now. What's so complicated about this? So it applies to people that are, again, remember, December 31st, unmarried or legally separated under a divorce decree at December 31st. So this is a really tricky thing to remember. Let's pretend you have a married couple. Let's pretend that they get legally separated in April of a certain year, and they are living in two separate abodes, and they have a legal separation agreement. Technically, even though their marriage might not, or their divorce might not be finalized by December 31st, in the IRS's eyes, they can each file as a single taxpayer. That is advantageous for the taxpayer instead of having to file married separately, which we're going to touch on in a couple minutes. So that's pretty crazy that that could play a role. So you could be married on paper, but a single taxpayer. And this is the the default filing status for unmarried individuals. Now, if you're unmarried, you could fit into one of the other. Actually, there's two other filing statuses you could be, but this is your default. So
Makes sense. Makes
single.
sense.
The second filing status we're going to talk about is married filing jointly. That means you're legally married on December 31st, even if you didn't live together the entire year. As I mentioned, you could have gotten married in May. If you love football, we know you're not going to get married in the fall. You could get married in August, I believe, like Johnny T did. Luckily, it was up in Michigan, so we weren't sweating too much in our tuxedos. These weddings in like Florida, Alabama, even here in Nashville in the summer, the guys really cook it up on those hot summer days.
It's like there's a reason why when I lived in South Carolina, getting married in the summer was deeply discounted.
And
The venues
frowned
couldn't
upon.
give them away.
And frowned upon, John. But married filing joint, in that filing status, what's happening is the spouses are combining all their income, all of their deductions, all their credits, all of their dependents. It does provide you with the highest standard deduction. So the standard deduction in 2024 was over almost $30,000. And the cool thing is if you file married jointly, you're still eligible for a full earned income credit, a full child tax credit, education credit. So in general, if you're married, from a purely a tax perspective, we're going to talk about later on when it might not make sense to file jointly, but from purely a tax perspective, this is the best filing status for you. However, if you do file jointly, understand that you're jointly and severally liable for any tax owed, even if one spouse earned the income. So, John, let's say you are some slug and your wife was a go-getter and she supported you and you didn't even help with your child. All you did was pet the dog.
But in having a basset on, that's easy because he's always in one spot. He's
Yes,
asleep.
and we know
So that's
Cooper
very
had
lazy.
some challenges with vision, but we still love him. And but even if one spouse under withholds on their W-2 wages, you're both jointly and severally liable. Now, there are some exceptions with innocent spousal support, and we're going to talk about withholding and that kind of stuff in the future, but later on in this podcast. So, married joint is typically your best option if you are married. Now, the third status is married filing separately. Okay, married filing separately. That means, so if you are married legally at the end of the year, that doesn't require you to file with your spouse. That's a common question as well. A lot of times people come into the teaching tax flow community. Oh, I got married. Do we need you don't have to file together. A lot of times it makes sense, but sometimes it makes sense not to file together, especially if you have maybe a second marriage, or you've got certain, there are some things that have been established previously that you are planning for. And the advantage of married filing separately is you're only responsible for your own tax return. You're not taking in that joint and several tax liability for your spouse. Now, if you file married separately, you are going to get disqualified for several credits, like the earned income tax credit. You're going to get a reduced child tax credit, and you do not receive the student loan interest deduction. So the point is, if you're married filing separately, you will have less ability in general to take tax credits and some of the deductions. Sometimes it makes sense, right? It could make sense from a financial perspective. It could make sense from a non-financial perspective. Let's say you have a lot of medical expenses, or one spouse can itemize. Now, if one spouse itemizes, the other spouse has to itemize. Well, let's say for some reason financially, and I'm going to put it at about 1, maybe 1.5%, it makes sense to file separately. You can do that. It might make sense if for planning purposes of somebody's income for student loan repayments based on their tax return. It could make sense if you're separated from your spouse during the year, you're not legally separated, or you've got some legal or financial concerns with your spouse, right? Maybe they are involved in a lawsuit. Maybe their spouse has got some things that they're working through that you quite frankly don't want to be a party to, and you don't want to file together. So that is married filing separate.
And with that one, Chris, I kind of, and not really a question for you at all, but to kind of what it sounds like for the non-tax guy in the room, it seems like that is extremely rare, and most of the time, I should say, extremely rare when it makes the most sense. But at some point, right, you almost, some individuals might make the decision like, you know what, yep, and I understand we kind of get nixed out of some benefit, but there's something else going on. It's more of a preference,
Right.
than a benefit, you should say.
I would say if I had to put a number on it, I would say about 1 to 1.5% of the time financially, it makes sense to file separately. I would say about 5% of the time, 3 to 5% of the time, it makes sense to file separately for other non-tax reasons. Let's put it that way. I shouldn't say financially, but yeah, for non-tax reasons. But they could be somewhat financial. They could be non-financial. They could be legal. They could be for a variety of concerns.
Makes
Or
sense.
quite frankly, you could have I've been doing this for a long time. There are taxpayers out there that quite frankly keep all of their finances separate. They're married. They have a healthy, what we would consider a healthy marriage. They just happen to say, we are going to both maybe contribute to the household financially, but what I do with my money and my investments, or what the other person does with their money and their investments, are completely autonomous, and they just file separately for that reason.
Or you can see it if somebody is a W-2, everything is very systematic for them. Around comes tax day, quote unquote. If you can't see it, they file it, they get their refund, they move on their way. The other person's a business owner filing extensions. They don't want to deal with it. They just move along, right?
There's
I
a
can
lot
see
of
that.
reasons. Absolutely.
Right.
So let's go with the 4th out of 5 filing statuses. Head of household, or HOH. It's kind of the S corp of filing statuses, right? It's got some attributes of a single taxpayer. It's got the attributes of someone that's married because you have dependents. But a head of household applies when you're unmarried or considered unmarried. Remember when we talked about that maybe legally separated at the end of the year. So someone that would typically file as a single taxpayer. However, they support a qualifying person or dependent, and then they're head of a household. The cool thing with head of household is you have you have a larger standard deduction than single, and your tax brackets your tax is reduced. So the same amount of income for a head of household person is taxed less than a single person. Means when we look at the tax brackets, now you remember us are fans of teaching tax flow, your marginal tax rate's more important than your tax bracket, but you ascend into the higher tax brackets at a slower pace, head of household versus single. So how do you become a head of household? Well, like I said, you have to support a qualifying person. What the heck does that mean? You've got to pay for more than half the cost of maintaining a home for a qualifying person, and the qualifying person has to live with you for more than half of the year. Typically, that qualifying person is going to be a child, but it doesn't have to be. And you can actually, in some cases, you could have a qualifying person that doesn't live with you. I'll give you an example. What if you have a parent that's mature aged, and let's say they live in your town, you rent an apartment for them, so they have some type of autonomy, but you actually provide more than half of their support. You could still be a head of household. Or what if, potentially, I guess, well, what if you have a qualifying student and they live on a college campus? That's considered a temporary residence. Again, head of household gets really sticky. So definitely
I
talk
love
to
that
a
comparison
professional.
to an S corp. I think that is the best way you can put it. And if anybody's wondering where that comparison comes from, I think we've done multiple podcasts now where we've talked about S corps. I won't. I don't want Chris's blood pressure, to go through the roof and his whole face turn red. So we won't really get into S corps, but he lit that fire.
Well, the reason I say it's like an S corp is, like I said, it's kind of a merger of two different filing statuses. So check with your tax professional. There are advantages to that. I will say, this gets really murky also, for lack of a better term. Let's say you have two parents that are not married and they have dependents together, and who's claiming what child, who qualifies for head of household. For those reasons, this is by far the most heavily audited filing status. That being said, if you qualify for head of household, absolutely file as head of household. Just understand that you're going to need that documentation.
Makes sense.
Final of 5. This one is called the qualifying surviving spouse. So if you are married and your spouse passes away, if your spouse died within the last 2 years, but you're still supporting a dependent child, you can file as qualifying surviving spouse, which allows you to stay in the married filing jointly standard deduction and file tax brackets, even though you might otherwise be single, or you'd be a head of household otherwise. All right, and you can do this for 2 years after the year the spouse passes away, assuming you don't remarry in that time frame and you maintain a home for a dependent child. So this really helps out taxpayers that are supporting a child, their spouse passes away. Bottom line is they still get to keep that quote unquote married filing joint filing status for a couple of years, which provides them with the highest standard deduction out of the 5 and the lowest tax brackets. When I say lowest tax brackets, that means you're ascending into the higher marginal tax rate at a slower pace, meaning at a higher amount of income.
And that last one that we just spoke of there, right? The QSS, I think they refer to it as, that's the only one that has a time restriction on it.
That's a great point.
Like,
absolutely.
Because every other one is really whatever the status is, whether how short or how long it is until it goes somewhere else. So that one seems like you mentioned, it's basically put in place as a transition period.
Correct.
Awesome.
Let me leave you with a few different pro tips I want to touch on real quick. In general, when married filing joints better to file when you are married versus married filing separate. Again, higher income thresholds is a positive. You do have full access to credits like earned income credit, child tax credit, lifetime learning credit / American Opportunity Tax credit. And then joint reporting can simplify a lot of deductions. Because think about this, John, if you're filing with a spouse and you both pay the mortgage interest or the real estate taxes, are you paying it both 50-50? Who's claiming what deduction? It gets a little tricky. So married filing separate, again, protects yourself from a spouse with some tax debt or unfiled returns. Let's say you can plan around certain itemized deductions, especially medical expenses, because they're subject to a 7.5% income threshold. And again, those income-based repayment issues related to student debt could cause you to go married filing separate. When you do get married, definitely talk to your employer if you are an employee and adjust your W-4 for tax withholding. A lot of times we see people, literally, John, 2 weeks ago in the Defeating Taxes private Facebook group, and that's kind of, we kind of put a tongue in cheek of, you can't put a price on love. We had a client, or not, they're not a client, but a member of the teaching tax law community say, I got married last year and I owed for the first time on my tax. What did I do wrong? Well, you didn't do necessarily anything wrong, except you probably didn't update your withholdings from your employer, because when you file jointly, you are combining your income, but if you file separately, the tax rates are higher than single.
That's some great advice to kind of close up on, like move it that way. So
yes, I do want to close up on one more thing though.
Yeah, absolutely.
You can't kick me off the stage yet.
I've been trying, man. I'm trying.
Know.
I'm trying. I'm going to shoot the Cupid arrow your way and see if I can just,
the final thing I'm going to talk about, it would mean that the arrow was like a boomerang. And unfortunately for Cupid, it got shot in the air, came back and stuck him in the belly. Because we're going to talk about divorce. Okay. Two things with that. First thing is, if you are, we know their filing status, the last day of the year is your status for the entire year. Alimony. So alimony, after 12/31/2018, this is through the Tax Cuts and Jobs Act. So any divorce decrees finalized in 2019 or beyond, alimony is not deductible by the person paying it and not taxable income for the person receiving it. For previous agreements, alimony was deductible for the person paying it and taxable income for the person receiving it. Child support is never a deduction and it's never taxable income. And then finally, there are some special rules around retirement plan distributions and the 10% penalty for early distributions. In what you're going to want to look at when you're talking about that are quadros. That's a qualified domestic relations order. So let's say, John, you have two taxpayers, they divorce. One taxpayer has a significant amount in their retirement account, and the court ordered them to transfer that to the other spouse. If that other spouse takes it as a distribution, it would be taxable. But if they're under the age of 59 and a half, typically there's a 10% penalty. If it's under a quadro, they don't have to pay that penalty. So tax professionals, you're going to want to talk to your tax professional and always provide them with a divorce decree if you run into this situation.
Now I feel like I learned something too. I've never heard of that quadro.
That's good though, John. So that means you're still married.
Huh. Yeah. Let's keep on that track. Otherwise, me and Cupid got some words to exchange with each other. Cupid, meaning it's you actually, buddy, because if it wasn't for you, I wouldn't have actually met my wife.
Oh, I've been known to be called the love doctor, and that's a story for another day.
That's a story for a whole nother podcast that we can fly under anonymity.
Yes. We will.
Anyways.
So remember, love is priceless, but your filing status isn't. Choose wisely, plan ahead, and don't let the IRS surprise you after the honeymoon or, John, a heartbreak.
Right to the heart. We need to play a theme song here, shot to the heart. Anyways, so yes, everybody is obviously, we talked about here. So there's different stages of this, right? There's different filing statuses. There's different phases of life people go through. I mean, obviously, I would say obviously, but majority of people, I would make the assumption, majority of taxpayers will transition out of one into the other, maybe back into one in certain situations, into a transitional one, as we mentioned. Don't be afraid. As always, reach out to us. Defeatingtaxes.com, as Christy mentioned a couple of times, there is our private Facebook group. Jump into that, drop any questions. You can do it anonymously. You do not have to put your name in there. That is a Facebook group, but there's an option for the anonymous posting. And more importantly than that, even, don't really do anything unless you talk to a tax professional. So yes, you can get a lot of advice from Defeating Taxes. We are happy to help out. I say we, meaning Chris and the rest of the team at Teaching Tax Flow. Trust me, you do not want any tax advice from the marketing guy. All I will do was drive you to somewhere else to get the right answer. But that being said, all seriousness, don't make any decisions when it comes to this without knowing exactly what you're doing, because as Chris, as you mentioned, there's pretty hefty implications regardless where you go, or if you don't do something, like you mentioned, updating your W-4. So any questions, you know where to reach out. We are here. We have a team of people ready to help you out as you need, and we will see you back here on the Teaching Tax Flow podcast. Next week, different day, completely different topic. Have a great week, everybody.
The content provided is for educational purposes only. We encourage you to seek personalized investment advice from your financial professional. For all tax and legal advice, please consult your CPA or attorney. Investment advisory services are offered through Cabin Advisors, a registered investment advisor. Securities are offered through Cabin Securities, a registered broker-dealer. The content of this podcast does not constitute an offer of securities. Offerings can only be made through an offering memorandum, and you should carefully examine the risk factors and other information contained in the memorandum.